Have you ever wondered how to make your money work for you? Well, you're in the right place. Investing is like planting the seed of financial freedom. In this beginner's guide, we'll explore the exciting world of investment opportunities in simple terms that anyone can understand. So, grab a seat and get ready to start an adventure into the world of investments. By the end of this guide, you'll have the knowledge and confidence to take your first steps toward a brighter financial future. In this guide, we will attempt to answer the following questions. What is investing? What are some of the major investment opportunities available? And does my risk tolerance level matter in investing? What is the need for an investment goal? What constitutes an investment portfolio? Before answering the above questions and discussing some of the investment opportunities available to you as a beginner investor or someone who seeks a better understanding of investment for wealth creation, we are excited to welcome you to the CoinsBro channel. If you're new here, remember to hit the subscribe button and click the bell icon to stay updated with our latest videos. We would also like to remind you that anything we say here is solely for educational purposes and doesn't constitute financial advice. Always do your research before buying or investing in any asset, as the majority of the assets, especially crypto, are very volatile. This video is for you, whether you're just starting out or looking to diversify your portfolio. Let's get started. Investing is a lifelong journey and a lifestyle. When done right, it feels like a game. People play games for fun and relaxation. You are encouraged to develop patience and sportsmanship as you prepare to venture into the world of investing and wealth creation. You will win some and lose some, but as you get better and grow in experience, you will begin to decide on your risk better, thereby resulting in fewer losses and better consolidation. Some people say investing is like planting a seed and nurturing it over time to allow it to grow. It's an intelligent way to make your money work for you, especially when done right. When you invest, you get to be a part of the economy's growth, and your money can keep up with the rising cost of things, like prices going up over time. At this point, let's begin answering some of the questions we raised at the beginning. We will start by explaining what investing is, following up on the background already discussed. So, what exactly is investing? In simple terms, investing is allocating or apportioning your money or resources into an asset, venture, or idea with the expectation of generating an income or profit over time. The key idea here is to make your money work for you, unlike saving, where you set aside money for future use. Sounds interesting, right? But remember, investing also comes with risks. As already mentioned, the primary goal of investing is to grow your money over time. This growth can be achieved through capital appreciation, the increase in the value of an asset over time. Income generation, earning regular income from investments, such as dividends from stocks or interest from bonds. Compound growth, reinvesting earnings to generate additional income and grow your investment exponentially. Here are some excellent investment opportunities to think about. They're listed from lower to higher risk, but remember, lower risk usually means lower rewards. High-yield savings accounts. Online savings and cash management accounts are unique places to keep your money, where it can grow faster than in a regular bank account. They allow you to earn interest, like a savings account, and offer features like debit cards or checks. Savings accounts are suitable for saving up for emergencies or vacations, where you only sometimes need to use the money. You can only take money out of a savings account a few times a month. Cash management accounts are more flexible and give you reasonable interest rates. If you're just starting to save and invest, keeping enough money in one of these accounts to cover your living expenses for 3 to 6 months is wise. After that, you can start putting more money into other investments. Bonds. Bonds are like loans you give to either the government or a company. In return, they pay you interest over a set period, usually 1 to 30 years. Government bonds are considered very safe because they are government-backed. However, they give a lower return than riskier investments. Government bonds are suitable for people who prefer a stable investment with less risk. They're especially popular with people close to retirement who want to protect their money from the stock market's big ups and downs. You can buy government bonds directly or through bond funds, which spread your money across many different bonds to reduce risk. Corporate bonds work similarly to government bonds, but you're lending money to a company instead of the government. These are riskier because companies can sometimes go out of business, especially if it's a high-yield bond, also known as a junk bond. These bonds offer higher returns, but they also come with more risk. Corporate bonds might be a good choice for investors who want a higher return on their investment and are okay with taking on some risk. You can buy corporate bonds individually or through bond funds like government bonds, mutual funds. A mutual fund is like a big pot of money collected from many people. This money is used to buy stocks, bonds, or other investments. Mutual funds are significant because they let you spread your money over various investments. This helps protect you in case one investment doesn't do well. Mutual funds are suitable for people who are saving for things like retirement or other long-term goals. They give you a way to invest in the stock market without buying and managing individual stocks yourself. Some mutual funds focus on specific types of companies like technology or ones that pay high dividends. You can buy mutual funds directly from the companies that manage them or through discount brokerage firms. Many of these firms offer mutual funds without charging you a fee to buy them. Remember that you usually need to invest a certain amount of money up front, but some companies might waive this if you agree to put in money every month automatically. Stocks. Buying individual stocks means you're getting a piece of ownership in a company. Stocks can give you a chance to make more money than safer investments like government bonds, but they can also be more risky, and their value can go up and down a lot. Individual stocks are best for people with a mix of different investments who are okay with taking on more risk. It's generally recommended not to put more than 10% of your money into individual stocks. You can buy stocks easily online through a broker. Once you set up an account and put money in it, you can start buying stocks and become a part owner of different companies. Another type of stock to consider is called a dividend stock. These companies pay out regular cash payments, called dividends, to their shareholders. They're suitable for any investor, whether you're just starting or getting ready to retire. If you're young and want your investment to grow over time, you might look for companies with a history of increasing dividends. This means they may only pay a little now, but could spend more. If you're older and want more stability or a regular income, you might prefer stocks that pay consistent dividends. You can buy dividend stocks like regular stocks through an online broker. Alternative investments. If you are not investing in stocks, bonds, or cash, you might be exploring alternative investments. These can include gold, silver, private equity, hedge funds, and even unique items like coins, stamps, fine wine, or art. Alternative investments are great for people who want to mix things up and spread their money across different investments. They can also help protect your money if the stock or bond markets aren't doing well. You can buy some alternative investments through online brokers, but others might only be available through exceptional wealth management firms. ETFs, like bundles of investments, also track things like oil, gold, or private equity, making investing in these alternative assets easier. Cryptocurrency. Cryptocurrencies are like digital money that doesn't need a bank to work. They are powered by the blockchain, and people can trade them directly without an intermediary. You can use crypto to buy stuff just like regular money. Some popular ones you might have heard of are Bitcoin and Ethereum. People invest in crypto for different reasons. Some think the value will increase over time, while others see it as a new and better way to use money. But it's important to know that crypto can be pretty unpredictable, so it's considered a very risky investment. You can buy and sell cryptocurrencies from several sources, like centralized and decentralized exchanges. Each has its own rules and fees, so it's good to research before you start trading. And remember, investing in crypto comes with risks, so be careful and only invest what you can afford to lose. Real estate. Real estate investing usually means buying a property and making money by selling it later for more, or renting it out for a steady income. But there are easier ways to invest in real estate without getting dirty. One such way is through real estate investment trusts or REITs. These are like companies that own buildings like malls or hotels. When you invest in a REIT, you get regular payments like dividends. Another option is real estate crowdfunding, which involves many people pooling their money to invest in significant real estate projects. These options suit people with investments who want to spread their money out more. But remember, real estate investments can only be turned into cash slowly, so it's best to avoid investing money you might need immediately. You can buy some REITs on the stock market using an online broker. Others are only available through particular markets. With crowdfunding, some platforms are open to anyone, while others are only for people with a lot of money to invest. Risk tolerance level. Now that we have discussed different investment forms, it is essential to note that your risk tolerance level is crucial in deciding on an investment option. Your tolerance level influences the types of investments you should consider and helps ensure that your investment strategy aligns with your financial goals and comfort level. Here's why it matters. 1. Investment choices. High risk tolerance. You might be comfortable investing in more volatile assets like stocks, commodities, or cryptocurrencies, which can offer higher potential returns but come with a greater risk of loss. Low risk tolerance. You might prefer more stable investments like bonds, certificates of deposit, CDs, or money market funds, which offer lower returns but also lower risk. 2. Financial goals. Short-term goals. If you urgently need money, for example for a down payment on a house, lower risk investments are typically more appropriate to avoid potential losses. Long-term goals. For goals that are many years away, for example retirement, you might be able to take on more risk since you have time to recover from potential market downturns. 3. Emotional comfort. Investing in high-risk assets can be stressful if you're not comfortable with the possibility of losing money. A portfolio that matches your risk tolerance can help you stay committed to your investment plan during market fluctuations. 4. Financial situation. Your overall financial situation, including income, savings, and other investments, also impacts your risk tolerance. You can take on more risk if you have a stable income and significant savings. 5. Time horizon. The amount of time you plan to hold an investment affects your risk tolerance. Longer time horizons generally allow for greater risk-taking since there is more time to recover from downturns. Assessing your risk tolerance. To determine your risk tolerance, consider the following. Age. Younger investors often have a higher risk tolerance since they have more time to recover from losses. Investment knowledge. More experienced investors may feel comfortable with higher risk investments. Financial goals. Clear, long-term goals can guide the level of risk you're willing to accept. Emotional reaction to losses. Consider how you've reacted to financial losses in the past. Understanding your risk tolerance helps create a balanced investment portfolio that aligns with your financial goals, time horizon, and comfort level, leading to a more satisfying and potentially successful investment experience. The need for an investment goal. Having a clear investment goal is essential for several reasons, all of which contribute to a more focused, effective, and satisfying investment strategy. Here's why setting investment goals is important. 1. Provides direction and purpose. Clarity. Knowing why you are investing helps define your strategy. Are you saving for retirement, a child's education, a home purchase, or another specific purpose? Focus. Clear goals help you concentrate on what's important, making it easier to make decisions aligned with your objectives. 2. Informs investment strategy. Asset allocation. Your goals determine the mix of assets in your portfolio. Long-term goals may allow more aggressive investments, while short-term goals may require more conservative choices. Time horizon. The duration until you need the funds influences the types of investments you choose. Longer horizons often mean you can take on more risk. 3. Risk management. Risk tolerance. Knowing your goals helps you understand how much risk you can afford to take. Different goals may have different risk profiles. Diversification. Goals help in creating a diversified portfolio tailored to your risk tolerance and time frame. 4. Measures progress. Benchmarks. Specific goals provide benchmarks to measure progress. You can regularly review your investments to see if you're on track to meet your objectives. Adjustments. If you are not meeting your benchmarks, you can adjust your strategy accordingly. 5. Motivates saving and investing. Commitment. Clear goals increase your commitment to saving and investing regularly. Discipline. Goals encourage disciplined investing, helping you stay focused during market fluctuations. 6. Financial planning. Budgeting. Knowing your investment goals helps you budget your income and expenses effectively. Future planning. Goals assist in planning for future financial needs and obligations, ensuring you are prepared for life's significant events. 7. Reduces emotional decision-making. Stability. Having goals reduces the likelihood of making impulsive decisions based on market volatility or short-term events. Confidence. Goals provide a sense of purpose and confidence, helping you stay on course even during uncertain times. 8. Customized investment plans. Personalization. Goals allow for the creation of a personalized investment plan that reflects your unique needs and aspirations. Flexibility. Specific goals make it easier to adapt your investment plan as your life circumstances change. Some examples of investment goals are: retirement. Put away enough money for retirement to ensure financial security. Education. Saving for children's or your educational expenses. Home purchase. Accumulating a down payment for a home. Travel. Funding future travel plans or vacations. Emergency fund. Establishing a safety net for unforeseen expenses. Setting investment goals provides a roadmap for your financial journey, helping you make informed decisions, stay focused, manage risks, and measure progress. It transforms investing from a series of arbitrary actions into a purposeful, strategic process aimed at achieving specific and meaningful outcomes. What constitutes an investment portfolio? An investment portfolio is a collection of financial assets and investments held by an individual, institution, or fund. The composition of an investment portfolio mirrors the investor's financial goals, risk tolerance, time horizon, and investment strategy. Here are the key components that typically constitute an investment portfolio. 1. Stocks, equities. Individual stocks, shares of individual companies representing ownership in the company. Stock mutual funds pool money to invest in a diversified portfolio of stocks. Exchange-traded funds, ETFs. Funds that trade like stocks but represent a diversified portfolio of equities. 2. Bonds, fixed income securities. Government bonds, corporate bonds, municipal bonds. 3. Cash and cash equivalents. Savings accounts, interest-bearing accounts at financial institutions. Money market funds, funds that invest in short-term, high-quality debt instruments. Certificates of deposit, CDs. Time deposits offering a fixed interest rate for a specific period. 4. Real estate. Direct ownership, physical properties like residential, commercial, or rental properties. Real estate investment trusts, REITs. Companies that own, operate, or finance income-producing real estate. 5. Commodities. Physical commodities. Tangible assets like gold, silver, oil, or agricultural products. Commodity funds. Funds that invest in commodities futures or commodity-related companies. 6. Mutual funds and ETFs. Actively managed funds. These funds managed by professionals who intend to outperform the market. Index funds. Funds that track a specific market index, offering broad market exposure at lower costs. Sector-specific funds. Funds focusing on specific sectors like technology, healthcare, or energy. 7. Alternative investments. Hedge funds are pooled funds that employ various strategies to achieve high returns, often with higher risk. Private equity. Investments in private companies, including venture capital. Cryptocurrencies. Digital or virtual currencies like Bitcoin and Ethereum. Collectibles. Tangible assets like art, antiques, and rare items. 8. International investments. Foreign stocks and bonds are investments in companies and governments outside the investor's home country. Global mutual funds and ETFs. Funds that invest in a diversified portfolio of international assets. 9. Derivatives. Options. Contracts giving the right to buy or sell an asset at a specified price before a certain date. Futures are contracts obligating the buyer to purchase or the seller to sell an asset at a predetermined future date and price. Swaps are financial agreements to exchange cash flows or other financial instruments between parties. Considerations for building an investment portfolio. 1. Asset allocation. The process of dividing investments among different asset categories to balance risk and reward based on the investor's goals and risk tolerance. 2. Diversification. Spreading investments across various assets to reduce risk. 3. Risk tolerance. The degree of variability in investment returns that an investor is willing to withstand. 4. Time horizon. The expected period an investor plans to hold their investments. 5. Financial goals. The specific objectives an investor aims to achieve, such as retirement savings, education funding, or wealth accumulation. 6. Liquidity needs. The ease with which investments can be converted to cash without significantly affecting their value. As already seen, an investment portfolio is a diversified collection of assets tailored to an investor's financial goals, risk tolerance, and time horizon. It includes a mix of stocks, bonds, cash equivalents, real estate, commodities, mutual funds, ETFs, alternative investments, international investments, and derivatives. Proper asset allocation and diversification are key to managing risk and achieving desired investment outcomes. Congratulations! Now you know some exciting ways to make your money work for you through investments. Whether you're interested in stocks, bonds, cryptocurrencies, or real estate, you have an option. Investing is a journey, so take your time, do your research, and stay curious. By exploring different investment opportunities, you're taking a proactive step towards securing your financial future. So, go ahead, dive in, and start building the path to your financial goals. Though it can seem daunting at first, with the right knowledge and strategy, you can build a solid financial future. Remember, the key is to start early, stay consistent, and keep learning. If you found this video helpful, please give it a thumbs up, share it with your friends, and leave a comment below with any questions or topics you'd like us to cover in future videos. Thanks for watching and happy investing.